All right, guys, welcome back to another episode of our podcast. Have you ever wondered how a single credit rating downgrade can have an impact on an entire world economy? This is a topic that we're going to be discussing today in the backdrop of the Fitch downgrade of the US economy, which happened recently. So, as you know, we've been creating these videos for the last few episodes, covering various topics of the day. This is Julian. I'm Jazz. Julian, do you want to give a quick, brief introduction to yourself to the people who might not know much about us?
Absolutely. So how can we talk about such an important topic and tell you in this video how a single credit rating downgrade can have such a big impact on the world economy and on our lives? I've been working in finance for now almost 10 years. I actually started my career the very first day in New York in the US, and hence follow US related topics on a daily basis.
Thank you. And I'm Jazz. I, like Julian, have been working in the finance sector for the last 10 years. I started my career in investment banking in the UK. And pretty much similar to Julian, I've been following as a part of the financial markets, the debt markets. And so credit ratings have been an important part of my career so far. So I think that's just a little bit of background about ourselves. So let's just talk a little bit about what exactly happened. I think what's happened is that that Fitch, which is a credit rating agency, has downgraded the U.S. long-term issuance bond issuance rating from AAA to AA plus.
What does it mean, yes? What does it mean Fitch downgrades the US? How can something like this happen?
So, should we start by giving the people watching this channel a very high-level overview of what exactly credit ratings are?
Yeah.
Why are they important? And just to break it down. So, do you want to kind of give like a high-level overview of credit ratings, how they work, the different categories of ratings, how many countries have the highest level of rating, etc.
Yeah, of course. So credit rating, I think essentially it's a measurement of assessing credit risk. So, for example, countries, corporations, individuals, we all borrow money from banks, from investors, from various sources. And these sources, they want to know how likely is it that you're going to receive your money back. And there's these credit rating agencies, and the biggest ones are Fitch, Moody's, and S&P out there. And what they do is they say, we are independent, we don't lend money to anyone, and we assess the credit worthiness of pretty much anyone and anything who comes and asks and pays a fee as well. And amongst others, what they do, or a big part of what they do, is putting credit ratings on countries. So if a country wants to borrow, then Fitch, Moody's, or S&P might say, okay, this country is, it reaches from a scale of AAA, which is the best rating, to all the way down when you default. It's a default, the lowest rating, and
Which is a D.
which is a D, correct. And if you think about it, if a country borrows money or lending money to a country, seems pretty safe. I mean, what is the chance? What is higher, the chance that my local, investment goes bust or that a country goes bust? So generally seen as pretty low risk lending money to countries. And then there is, for example, lending money to Bolivia might be more risky and might have a lower credit rating than lending money to the US. And now what has happened is the highest of them all, the highest credit rating, the AAA credit rating, which only a couple countries in the world have. The US used to have it, but it no longer has it.
And the Nordic countries have it. They still have it along with Germany. So, which is a very interesting situation that the US finds itself in now. And so I think so. This is a helpful background, Julian. I think people will ask, why should they care about this? They'll say, I'm just an average person, living in whatever city. If the US has been downgraded, the US sovereign rating has been downgraded, what does that really mean to my everyday life? And I think the US is in an exceptional situation, which we'll go into, where it's the reserve currency of the world, et cetera, et cetera. But theoretically speaking, a downgrade of a country, why should it matter to a common person?
Mm-hmm. Why should it matter? Good question. So I think, first of all, to establish a baseline, if we go years back, the US, the largest economy in the world, right? Largest. After that, it's China, and
Yep.
I guess the dynamics in the US economy is very different. If you look at the GDP per capita, it's very high. I think it's in the 70,000s, whereas the second largest economy, China, is like very much a low income economy with GDP per capita of 12,000 or something like this. So not only are you the largest,
Yeah.
you also on average a high income economy, meaning on average what the average person produces in the US is one of the highest amongst actually all countries in the world. And if you go, let's say, 15 years back, then all the credit rating agencies would say, the US, it's a AAA credit rating. And the reasons for that was, the dollar is seen as the reserve currency. That means, for example, that certain commodities, when you trade them, oil, that's not quoted in pounds
Yeah.
or in lira or in euros. That's quoted in dollars. It has the global reserve currency. Um, and status as the largest
Yeah.
economy of the world. And hence, what was historically the case is that it's a AAA rating.
Yeah.
And this has changed. So 10 years ago, roughly, S&P put it that the US is no longer a AAA rated country. And now very recently, Fitch
Yeah.
has come out and said, okay, it's no longer a AAA. It's the one notch below that,
Yeah.
which is a AA plus, which is still very good, but which is no
Yeah.
longer the best.
And yeah, I mean, I think to your point, I think it's relevant for a person on the ground
Yeah.
who might be thinking, how does it impact them?
Yeah,
But
exactly.
really, if you think about it, what it effectively means is that the lower you go in the rating categories, which Julian described, it signifies a higher risk. And so to compensate for the higher risk, an investor or a person buying the country's bonds, essentially providing the country a loan, they require a higher interest rate for that risk. So theoretically speaking, the US is an exceptional situation, but theoretically speaking, what it effectively means is that when the credit rating is downgraded, for the higher risk profile of the country, interest rates should increase for the same bond which is to be issued. And how does this impact people? I think clearly when interest rates increase, all the other interest rates, so bank mortgage rates, they usually follow suit. So that's one. People's mortgage rates increases, that effectively has a downward or a worse impact on various asset classes, right? Equities, debt, whatever, real estate. So that's obviously one clear impact. And the other one would be if a country's credit rating is downgraded, effectively the other investors in the world, they would consider, for example, the relevant currency to be weaker, or they would sell that currency, and that currency becomes weaker. And so for the same amount of goods that that currency would buy, now it would buy less. And so it would cost more to import. And so effectively what it means is that your inflation rate, the country's inflation rate, would go higher. And so it does have a definite impact, and several lower down the chain impacts, which do matter for the average person. And we can talk about several examples about how this has happened in Brazil, in Argentina. These countries have a very low credit rating, and effectively Argentina, when you're close to a default, people don't want to hold the Argentinian pesos, and so when the currency is devalued, then if an Argentinian person wants to import something from the US, it just costs a lot more money. And so it's just a way of it just causes an inflationary spiral, because the country needs to keep on pumping money out or issue money to buy more goods, and so it creates an inflationary spiral. So it does have an impact.
So let me ask you the question:
Yeah.
Is that actually what happened in the US now when Fitch downgraded the
So
rating?
let's actually talk about this, right? And like you mentioned, this has happened previously. So S&P has downgraded the credit rating of the US back in 2011 for similar reasons, and we will talk about the reasons as well, but that's just the historical context. Previously, when it was downgraded, it well, there was a period when the stock markets went down. There was a week or slightly longer period where the stock markets was down for almost 7%. And so I think there are different trains of thoughts, right? Theoretically speaking, it should go down, and it did go down, and it did have an impact.
Why should that be the case? Is the risk of the US higher from one day to the next when
Yeah.
S&P
So
comes out and says it's no longer a AAA?
yeah. So I think the way to think about this would be, you think about government debt as an asset class, right? So like you were discussing, there's government bonds, which is an asset class. There's equity markets. There's real estate. There is corporate debt. These are all different asset classes. When the US sovereign debt was downgraded, it effectively means that it's become higher risk. And as we discussed, to compensate for the higher risk, you have to pay a higher interest rate. And the US government debt is the de facto risk-free rate for the world, right? And risk-free rate is something that, a finance person is just, something that they see from on day one, and when they look at, capital market pricing models and etc. But the risk-free rate, if that goes up, it basically means that the discount rate for various asset classes and how you value those assets, that increases, and so the valuation of all those assets goes down. So that's the theoretical way how it does impact the pricing of various assets. But interestingly, what happened with the S&P downgrade in 2011 was, there was a risk off sentiment. And what does risk off mean? That people were basically more fearful about, the state of the global economy. The US has been downgraded, and paradoxically, what tends to happen in a sell-off environment is that people go to the de facto risk-free asset, which is the US debt. And so, in a weird way, because the US is in a unique position of being the reserve currency of the world, and being their de facto risk-free asset, when the rating was downgraded, you would have expected the interest rates to go higher, but because there was a risk-off sentiment, people started buying more US government bonds, and actually the interest rate remained the same as it was. And so, even though there was a period of lull where the stock market did go down, eventually, as we know now, everything went back to normal, because that's the main point, right? It's the reserve currency of the world. To your point, that's the way various asset classes are priced. They're priced in dollars. Commodities are priced in dollars. So it didn't have as much of an impact. Do you think, though, that we'll be in the same situation now, where I think, and we can provide maybe the viewers a little bit of context around, what are the reasons for the downgrade, and then what are the ramifications? But maybe, do you want to talk a little bit about the reasons that were given
Yeah.
by Fitch?
I mean, the 2 points you say, the reasons, and are we in the same situation now? Are we in the same situation now? Absolutely. I mean, actually, when Fitch downgraded again, nothing much has really happened. The US is still the largest economy in the world. The Treasury bond market, which is, I believe, a 30 trillion US dollar market, is still the largest bond market in the world. Investors are buying and selling this, and nobody was really spooked by this downgrade. Just that, Fitch says, "Oh, we think the credit worthiness is no longer the absolute best. It's just a little bit below the absolute best." Actually, no investors seem to care. The reason why they say, "Oh, look, people should not see the US as the risk-free rate anymore," as you've described it. They say, it's no longer AAA, it's less than this. So people, be careful, there is some risk attached to it, is several-fold. I mean, one is, you look at what happened during COVID, government borrowed a whole lot of money, and debt to GDP really spiked. So right now, I think in the US, so somewhere over 120%
Yeah.
debt to GDP. And that comes with some ramifications. I mean, one, you look at the total spending of the US government, interest is now 10% of that, which is an enormous
Crazy.
amount. Yeah. If you look at how much is the government in the US borrowing, so you could say, the US had a fairly successful path out of COVID. I believe 2020 was like minus 2.8% growth, but then it shot back up in 2021 with almost 6%. 2022 was pretty good, just below 3%, and this year still growing positively. So really good trajectory, actually. But if you look at, government spending, federal spending, then the US running is this year a deficit of somewhere around 6%.
Yeah.
Maybe even more. Let's see where that shakes
Yeah.
out, or probably
And
more.
actually, just for the viewers, can you describe what deficit exactly means?
So deficit means, so a government has revenues, money comes in, which is mainly taxes, and it's the same as a government. You spend.
Yeah.
You spend on roads, on hospitals, on schools, on servicing your interest. And at the moment, the US spends more than it actually makes as revenues, and hence, how does that work? You need to borrow more money.
Yeah.
And at the moment, that's more than 6% every year. And what Fitch is saying, or some people are saying, like, hey, look, you already have a massive amount of debt, 120% debt to GDP. You're paying an enormous amount of interest, 10% of your total revenues. And you just keep on borrowing more and more and more. And you're not really growing enough.
Yeah.
How is that sustainable? And this is the big question that now some people are starting to ask. And the market is not yet spooked by it.
Yeah.
But there's definitely discussion going on. Hey, is this sustainable for another 10, 20, 30 years? Or, can this debt ever be repaid or not?
Yes, exactly. And I think just to build on your point, I think the one other reason that was provided, which I mean, I think the main reason is pretty much like you mentioned, right? Around the fiscal sustainability of the path that the US is in and other economies across the world are also in. But the US, in this case, they are in a slightly let's call it untenable sustainability position according to the credit rating agency. The other reason, because there's also a subjective element to this, right? And the subjective element of a credit rating methodology is around governance.
Hmm.
So I think the point that they made around governance was the fact that the usual process around increasing the debt ceiling and the negotiation that goes around it made the credit rating agency Fitch feel that this is a process that's not very well managed, even though there's a historical track record of the U.S. always increasing the debt ceiling
Hmm.
in order to allow them to borrow more money. To your point,
Hmm.
when there is a deficit, but the fact that they always find themselves in this situation where there's this political negotiation between both sides of the house to increase that debt ceiling made, and it kind of it always goes to the wire. It always goes to the
Yeah.
11th hour, and that makes people nervous and the market's
But
nervous.
I've got some sympathy for that. If the U.S. continuously is 2 days away from default, whenever this debt ceiling limit approaches, is that really riskless? Is that really the best
Exactly.
credit worthiness? If anything goes wrong, you have
Yeah.
2 days left, and that's when the president signs. That's when politicians
Yeah.
agree on lifting the debt ceiling and committing on various spendings and spending cuts. Should that be seen as AAA? Is that really the best credit worthiness?
Yeah.
I
And
don't know.
yeah, and I think this is a very good point. And actually, I think we should talk about what exactly transpired after this news happened. So I think you might think this was just in like another boring news and people just forgot about it, but the U.S. Treasury had some
They were angry.
harsh things to say about it. So do you want to talk about that? What was the reaction of the U.S. government?
Otter just said it's unfair. Obviously, they would say that. I mean, Janet Yellen, she came out, she said, like, this is old data. The governance has continuously improved under the current administration. Fitch was only apparently looking at GDP data up to 2020 or something like this. In the UK, the US has recovered. And it's just very unfair. But, I mean, you would expect the government to say that, right? And especially politicians who want to get reelected, you would expect them to say, "Oh, of course, under our government, everything is better." If someone says things are worse and your credit worthiness gets downgraded, that's not true. I don't know. I think there's a little bit of politician speak.
Yeah,
What's your
no,
view?
I think pretty much in the same boat as you. I think what it's a fairly controversial decision to be taken, right? I mean, I think it's de facto, like we discussed, risk-free asset. And really, I think, I mean, the reasons for it, we understand it, right? But I think it's not surprising that the governmental body that is managing the process of the sustainability of the fiscal path of the economy, who are responsible for this, if their job is effectively, if they're being called out by a rating agency saying you didn't do a good job, of course
Hmm.
they would come out and want to protect their interests and the interests of the country as well, right? So I think it was not surprising, but it just goes to show that it's not, just for the viewer watching it, is not a small piece of information or just something that you forget about. It is a major thing which has ramifications for the common person, but the economy and
Well, I think the reason is, once all these negative effects that you stated, if the market says, "Oh, we don't care what credit rating
yeah,
agency does," and like, maybe, for certain investors who have a mandate to allocate into AAA, the effect also might not be
yeah.
there because the mandate is usually you need to buy treasuries, not AAA treasuries, just says treasuries given the size of the market.
Do you want to talk about this point in a little bit more detail around, how do investors think about AAA and the mandates point that you mentioned?
Well, I think, some investors, if you're a pension fund insurance company, is going to say you need to put X amount of money into AAAs. Or it might say, if your insurance company, you let's say you measure your risk internally, and what you use for that is credit ratings.
Yeah,
And if there's a worse credit rating now in all your US holdings, then you might be penalized, and maybe you need to sell some of them in order to improve your metrics and invest into something higher rated. But here it doesn't really seem to be the case because the mandates usually call for treasuries are seen
yeah,
as an asset class just because it's so huge, not
yeah,
attached to a rating. So that didn't really matter. And I think the point is where it will matter is if people lose confidence, if suddenly the market thinks, oh, actually there is a big risk of the US not paying now, paying back their debt or servicing the interest, then suddenly I think this could lead to a spiral where all these things happen, that the cost of borrowing goes up, your mortgage rate goes up,
Yeah.
economy might go into recession. And this is something similar we've seen in the UK not too long ago.
Let's actually talk about it. This is a very good point, and actually, this is a this is a plug back to our episode number 1
Oh yeah.
of how we started this journey, where we talked about the mortgage crisis. Well, not a crisis, but the mortgage situation in the UK. And so, do you want to give a little bit of context around the mini budget, which happened a few months ago? Actually, when was it? Do you want to provide some historical context to people around, what exactly happened and how is this connected to this situation?
Well, I guess in short, what happened in the UK is at the time Liz Truss was prime minister and Kwasi Kwarteng was the chancellor. They came up with a new budget. So the budget is saying, how does government, spend the money, and how much taxes are we going to collect? And essentially, what they proposed was, oh, let's spend much more and lower taxes because we're going to boost growth, right? And the idea was, yes, we need to borrow more, but at the same time,
Yeah.
we're going to grow so much more that it doesn't really matter because we will be much bigger.
And actually, this was in the context of COVID, where they already issued a huge bunch of bonds to effectively finance it. And then what happened?
Well, the thing is, it never got to play out. So to this date, we cannot be sure what would have happened if we had followed through, right? Because that whole policy, that whole budget was turned around after just a couple of weeks. And the reason for that was, the day that budget came out, the market formed the view that, no, we don't think this is sustainable. If the UK does it, the debt will spiral out of control. We cannot say for certain if that would have really happened. Obviously, Liz Truss, Kwasi Kwarteng thought it was a good idea, but everyone else thought it's a terrible idea. So what happened is exactly what you said. People didn't believe the UK can pay down its debt anymore. People sold the debt. Borrowing costs for UK government went up. They had to pay way more interest. Actually, the central bank had to step in order to support the pound. So it was a huge disaster, essentially. Yeah. And they had to do a complete U-turn and turn around lots of things that were in this budget, and because it's a loss in confidence.
Yeah.
And now, if this, coming back to the US, if that downgrading credit rating agencies, together with other factors, can lead to a loss of confidence of investors and markets, people don't trust the US anymore, that could have quite big impact.
Yeah.
But this is not what we're seeing as of right
exactly
now.
Yeah, I think we're not there yet, because effectively, and we may never be there, because effectively the US is the reserve currency of the world. This is considered the safest asset class in the world. The US has the benefit of being the global economic powerhouse, and it has traditionally, it's been seen as the country which has the safest overall governance framework and transparency of the system. Like you mentioned, different asset classes are priced at the US dollar, which effectively is the reason why they've been in the situation where they are this one country. Oh, we should this unipolarity of the world, where they are the one country which has all the economic power at this stage, and the defense power, and so they can just keep issuing debt because no one ever doubts it.
So do you think the US should still be AAA then? Do you think it's riskless?
And this is a great segue. We should talk about this point and also what it actually means going forward. Like, what are the ramifications of this? I think the point is that I do agree that the fiscal sustainability of an economy matters. Just like us as individuals, we need to manage our budget. We need to spend less than we make. I understand that a government works slightly differently, especially if it's the U.S. government. It works slightly differently, but we are in a situation where effectively the interest on the government debt of the U.S., to your point, is almost 10% of the revenue of the U.S. And so what this effectively means is that going forward, they just need, if they're not able to grow the economy, and as a result that the revenue doesn't go up, then they're paying 10% of the annual revenue in interest, which
is absurd,
which is a huge amount of money. And so if you think about it, and if you bring it down to ramifications, what does that really mean? What it means is a government needs to spend on, so the US government needs to spend on various things, right? I mean, there's Social Security, there's Medicare, there's defense, there's a whole bunch of expenses that need to be made, and the way they make or the way these expenses are covered is through taxation, it's through tax revenue. And so what it effectively means is that something, if the US now takes this as a wake up call, right? If the US government thinks that, okay, we have to do something about this, which I think, to be fair, there are calls to look into this closely,
Yeah.
right? But what does this mean now? So I think either the taxation, because it's just an equation, right? Like revenue minus costs equals your deficit or surplus. So either your revenue needs to go up or your expense needs to go down.
Yeah.
Something has to give. Now, this is where we are in a very interesting situation, because various polls in the US have shown that there is little to no appetite from people to have the Social Security package and Medicare, etc., to be cut.
Mm-hmm.
So it's almost
Unsurprisingly.
I think it's overwhelmingly people, almost 80%. I think in the last poll that came out, people do not support cutting any entitlement plans. And I think the way things work right now, because we are coming into election cycle,
Yeah.
no politician is going to be elected into power if they say they're going to cut
Mhm.
entitlements. And so we are, unless there is sort of bipartisan support in both sides of the house to cut expenses, there is no way out here. The only way out would be to increase taxes. But again, that's a very controversial opinion, and I think under the Republicans, obviously under Trump, I think the tax rates were cut. And so I think we are in this situation where it's incredibly difficult to balance and to figure out how this would eventually pay out. But do you want to talk a little bit about, like, what's your view on the ramifications and how are you thinking about
Well,
things?
I think you mentioned, so I think this during the current government, not much is going to change. The debt ceiling was amended until, I believe, 2025. There's no more
Yeah,
debt ceiling. So, there's a little bit of time. I think the next election cycle, one of the big topics, I believe, is going to be fiscal sustainability of the US. And, you can look abroad, look at the, what is it? I think number 4 global economy, Germany, the largest European economy. And if you compare how's Germany doing it, and I think Germany, for example, looking into Europe, would be, pre-COVID was always running a surplus.
yeah,
And how has that been done? It's just a careful budgeting between revenues and costs. And I think the US will have to start doing something similar. I think for
yeah,
one, if you run a 6% deficit, but 10% is interest, if that interest comes down, that's going to help a lot.
yeah,
Just you have to spend less on your interest burden. I think that can be one way out, and the other way out is, I think, just needs to be, well, growth can be a way out.
yeah,
There's a lot of hype around artificial intelligence.
exactly.
A lot of it is driven by the US. There's some, there could be some breakthrough technologies. I mean, there's more and more exciting news about fusion technology coming out. That might not be something for this decade or next decade. Let's see.
Yeah,
But it just takes a couple of inventions, self-driving cars, etc., that can really boost an economy.
yeah,
I think this is another way out. And otherwise, I think we just have to count on the responsibility of politicians
yeah,
not to let this become a spiral where you borrow, borrow, borrow just to finance your interest. Because otherwise, let's say Fitch comes and downgrades another notch in 2 years' time. Maybe people will see it, the market will see it quite differently.
yeah,
And then we start the spiral. So I believe the way forward is also look abroad a little bit, how are other countries doing it, and be more disciplined,
yeah,
and hopefully, the ideal way would be
yeah,
we grow out of this
yeah.
by just making the economy bigger.
Yeah, no, I think this is very well said, and I think effectively it's not all doom and gloom, in the sense that something similar happened in Canada when the Canadian rating was also cut, and I think the Canadian government took it as a sign. This was back in the 90s. They took it as a sign to embark on this journey, pretty much like you mentioned, around balancing the budget. And what effectively happened was, over a period of several years, the government managed to balance the budget, and they were able to retain or increase their rating back to the original level. So I think there's obviously a path for the US to come back to that rating again. But it's a question of, is there support to balance the budget, which I think it should be, but is there support to look at these various elements. To your point, growth is the big what's the word for it? But that's the biggest X factor here, right? Artificial intelligence, what's happening with energy prices, all of that coming down, onshoring of manufacturing back to the US, all of these things are happening, and so maybe there will be a huge amount of growth, and so they don't have to worry about it. But I think time will tell. But interest rates, I think I'm curious to hear your view about this because you're close to the market on this. There are two trains of thought, right? One says, I think now we're in this world where, especially on the back of this downgrade, but also just because there's the government is taking money out and there has been rampant inflation, interest rates will just remain at this high level, right? What do you think about interest rates in the context of this downgrade? Do you see them still remaining here? Do you see them coming down? Curious to hear your views on that.
Yeah, coming down definitely. I think the market view right now is that we're at or around peak interest rates, and that the Fed is going to start cutting early next year. And the reasons is really you look at inflation data. So the latest inflation from the US, I believe, was 3.1%.
Yep.
Core inflation, which is, excludes the volatile part of the economy. So it excludes food and energy, is still quite high, more than 4%. I think 4.8, something like this. So we definitely do still need a cooling off of the economy. But with interest rates really edging closer and closer to this 2% target, and actually economy, doing worse and worse, and we're edging closer to a recession, I think the universal view is that next year, 2024, we'll start to see the Fed cut interest rates. And then hopefully, we're going to be in a situation where, inflation is under control and growth can start to pick up again.
Yeah, no, I think that's yeah.
So
I think
conclusion, would you still lend your money to the US?
No, absolutely. I think it's the US economy is the safest economy in the world. That's the house of where all the economic growth, is happening. At this point, economic growth meaning productivity and technological evolution is happening across the world. But really, let's be honest, it's in the US that most of this is happening. It's got the biggest defense and the overall. We can talk about the way Ray Dalio thinks about this, right? But it's got the biggest defense system. It's got the strongest economy in the world. The strongest currency in the world as well. And so I think it's safe to say that the U.S. economy and the overall risk profile of the country, maybe it's impacted on the margins, but really for the average investor, nothing really significantly changes. I think it remains as is, but it's an important point of data for the government policymakers to keep into consideration as they think about what to do in the coming years.
So we stay in this position and don't end up in a position where
it becomes even worse.
All right.
No, so I think this was a good discussion. I think if you've got a strong view on this, we're very curious to hear your views on this as well. For the average person, please write, comment to us below. Also, if you've got any other suggestions on topics, just feedback on how we are running these videos. If you want a different mode of us providing this information, I think we were discussing maybe we should do a whiteboard, for example. If there are any suggestions, please let us know. Julian, any other?
And if you're watching until the very end, if you're still on, like the video, leave a comment.
Exactly. Now, thank you very much, and we will see you next week.